before that, we are going to see how we can apply the conceptual framework that we have covered in the last class and apply that in a business transaction. Okay, so I have given you the slides earlier. I will go through the slides today, and please stop me if I'm too fast, right? And then if you have any question, you can just ask me in the midst of the discussion. Okay, so the conceptual framework for financial reporting in chapter 2, we have actually looking at what is the conceptual framework and what is the content of the conceptual framework. Yeah, so we have looked into, we know that it's a concept that guide, so it's a guidelines, yeah, to ensure the consistency of accounting standards. So why we need that? Because of course later we look into the purpose of the conceptual framework, right? In other words, it's to provide assistance to standard setters, to accountants, to auditors, users, and anyone interested in the financial reporting. So we have a framework to refer to as a guideline. And then in terms of the content of the conceptual framework, we have looked into the general objective of the financial reporting. We have looked into qualitative characteristics of useful information, what are the underlying assumptions, and then looking at the elements of financial statement. We are looking at the recognition of elements of financial statement and the measurement. So one is how to recognize the elements and how to measure. So what are the elements? We have the asset, liability, equity, income, and expenses. Yeah, so how are we going to recognize those elements? How are we going to measure those elements? Yeah, and finally on the concept of capital maintenance. Okay, so what are the main objectives of financial reporting? Right, of course, is to provide financial information which are useful, yeah, for decision making. And who are the users? It could be your investors, could be investor, of course, the shareholders, all right, lenders who provides you with credits. Creditors are the one who give you supplies of your inventories, of your materials, your employees, customers, government, and public in general. Right, so the qualitative characteristic, all right, as mentioned in the conceptual framework, all right, there are two types of fundamental qualitative characteristics. What are those? Two fundamental qualitative characteristics. Anyone? Selak.
Relevant.
Sorry? Relevant
and faithful representation.
Yeah, faithful representation. Yeah, relevance and faithful representation. In order for what are the components of relevance? Then they have three. We have predictive value, all right, materiality, and conformity, right? Then what? What about the faithful representation? It has to be complete, all right? It's not biased, and then it's free from error. In order to enhance the qualitative characteristic, all right, they come up with four more: comparability, verifiability, timeliness, and understandability, right? So comparable, it means that in order to allow comparison of the financial statements between similar information with other entities. So you normally want to compare how one company is doing as compared to other company. For example, as a shareholders, as an investor, I want to know, should I invest in company A or should I invest in company B? All right, so how do I compare? So I look at the financial statements of these two companies and see which one is doing better, and then will help me to make a decision whether to invest in company A or invest in company B, all right? Or we can also use comparability in order for us to compare the performance of between year 1 and year 2, or year 3 or year 4, year 5, right? So you compare the performance of company, we call it as a trend analysis, all right? You compare from year to year how the company is doing. And this one is very important because, for example, the shareholders would like to see the performance of the company from year to year. Should I continue to invest in the company? Lender would like to see if the company is doing better or worse, because that will affect their ability to pay for their loan, for example. Yeah. So in order for us to be able to compare, right, to have a comparison, comparability characteristic, we have to use a consistency. It means that you have to use the same method for the same items from period to period. Right. So when you have that consistency, that's how we say that we are comparing apple to apple. All right, not apple and orange. So you cannot compare between these two because it's not the same, right? The characteristic of apple and characteristic of orange is not the same. So you have to make it consistent. So we have to make this one based on apple, and you measure this one also based on apple. The method is also apple, here is also apple. So then only you can compare, right? So comparability is the goal of the financial statement, yeah? But in order to be able to use that comparability characteristic, we have to use consistency. So you say that consistency helps to achieve the goal to compare. All right, verifiability, it means that different knowledgeable and independent observers could reach a consensus, right? Not necessarily complete agreement, means that it doesn't have, everyone has to be 100% say the same thing, but in general, they should come up to the same conclusion about the financial statement of an entity. Yeah. All right. So that a particular depiction is a faithful representation. So when a knowledgeable person, for example, you're talking about auditor. All right. If you have quality, we have the compliance officer to look into the financial statement, they will come to the same conclusion. That's why I say that verifiability. Yeah. So this says that, okay, this one is a faithful representation. So the financial statement is a faithful representation of the company's performance. Timeliness, as I mentioned, right, information is available to decision makers in time for them to make their decision. All right. So it's very important to be to have the information timely, right, relevant, that is interrelated. Yeah. Understandability means that classification, the characteristic, the presentation of information are clear and concise. So it means that that's why we have a standard format. For example, in preparing your statement of financial position, right? So how is it supposed to be presented? All right. You have asset, liability, and owner's equity. All right. And in terms of the asset, how is the classification of asset, right? So all these things is made the conceptual framework line out how it should be. For example, in order to make that everyone that reads the financial statement, if you read financial statement of company A and read financial statement of company B, it should give you the same understandability. Yeah. So that is the additional or enhanced qualitative characteristic of the financial statement. And of course, at the end of the day, you want a useful information. And I mentioned earlier, is all these are cost constrained, right? But we are not able to let go of this quality, right? Because it's very important. Whether you like it or not, it has to be there. Okay. So now we have one is conceptual framework. The other one, we have a standard. So what's the difference between conceptual framework and financial reporting standards, right? So as I mentioned last time, conceptual framework is a guideline, right? It provides a general guide on how financial statements should be prepared. So when I say it's a guide, it means that it's not a law. It's not an abiding. You have to abide by that framework, the conceptual framework. No, it's just a guideline on how financial statements should be prepared. All right. On top of that, the conceptual framework also set up principles, all right, which are general concepts. Again, it's a general concept. It's not very specific. Applicable to a wide range of issues, and it's not an accounting standard. So when there is a conflict between conceptual framework and an accounting standard, of course, we have to follow the accounting standards, right? Because it's very detailed and it's a law. We're talking about a standard, it's a law that you have to follow. So let's look at the financial reporting standard. It says that it provides guidance again on a very specific issue related to financial reporting. Example, the standard will tell you how to account for inventories, all right, how financial statements should be presented, and how to apply fair value measurement. So this is clearly elaborated in the standards. Framework, all right, conceptual framework just give you a concept. Standards apply the concept. You see? So for example, it says that, okay, you should have, the financial statement should be understandable. So how do you make sure it's understandable? So that is how the standards laid out how it should be done. All right? And of course, the financial reporting standard apply concepts as set out in the conceptual framework. They use the conceptual framework as a guideline in coming up with the financial reporting standards. Right? So let's look at this example. I like this example where it actually give you an overview, right? An overview of how we translate or how we apply whatever we relate back the daily transaction, right? The business activities, we translate that into the concept, the elements of the concept in the conceptual framework, right? So in this example, right, I hope that those without accounting background, I really hope that you'll be able to see this example and see how this story will be related back to what we have covered earlier, right? And this is how we are going to use, or we are going to prepare our financial statements based on this kind of business activities, right? So we say that here, I'm Mr. Anoni. I'm starting a bookshop. All right. Before you say that, you have to understand what a bookshop is. Is it selling books, or books is a goods? Yeah, goods are books lah. So you are selling a bookshop, of course, that sell books, right? And they also provide some maybe loan service. In this case, they loan the books to others, yeah? So let's assume it's a bookshop that sell books only. So he said that I have invested 45,000 and took a bank loan of 5,000 for my shop. So in this case, Mr. Anoni is also a shareholder because he has invested his own money amounting to 45,000 ringgit into the bookshop and took a bank loan of 5,000 for the shop, right? So how much money do the company, the bookshop now has?
50,000.
50,000. So now this is what we call, you have capital 45,000 from the shareholders, and you also have 5,000 from the bank loan, right? So now you have 50,000, and what happened with that 50,000? Mr. Anoni, who is actually the owner of the books, is also the shareholder. He bought a small shop, and that small shop cost him 40,000. And in order to start his business, he bought a cash register. The cash register means that the cash register, how do I say it? That whenever you have the money, you put the money inside there. So that sales, you have push the button, everything. So that's a cash register that costs you 1,000 ringgit. And you also bought some furniture and shelves that cost you 4,000 ringgit. And then you also, of course, you want to sell books, so you have to buy books, all right? And that costs you 3,000. So how much you have you have used the money? 40,000 to buy a shop, 1,000 for the cash register, furniture and shelf 4,000, and you bought books of 3,000. So total now you have 40, 41, 45, 48,000. So where's the balance now? How much balance do you have?
2,000.
2,000.
2,000. So
2,000.
the balance 2,000 must be in the form of cash. Yeah, so that's the money that I have not used. So means that that is the cash that I still have in my bank, right? So assuming that whatever 45,000 and the 5,000, everything you put in the bank. So if you want to buy, you will withdraw your money from the bank, or you do online transfer nowadays, whatever. So whatever cash that you have is 50,000 minus all this. So that's the balance that you have. You have a cash of 2,000. Right? So understand the scenario. As an investor, put money plus borrow money from the bank. With all the money, 50,000, you have spent for all these things. Okay. So now we say that, okay, what are the elements of financial statement? We have the asset, liabilities, and equity. So what is an asset? Asset are resources controlled by the entity. Results of past events, whether you buy the asset or maybe it was donated to you, how you get it, all right? But asset is due to the past events, all right? So asset is also expected to provide future inflow. Yeah, inflow means that something that will come into the business of economic benefits. So what are example of assets? We have cash, we have receivable. Remember I mentioned about receivable, something that you're going to receive in the future. You can also have your building as your asset. You can have your plant. Plant here refers to plant, it's not plant like a tree, yeah. So plant here is like a machine, yeah. Machine, plant, and machinery. What about liabilities? It presents obligation of the entity. All right, result of past events, and the settlement results in an outflow of resources. Kalau asset is an inflow, liabilities is an outflow. All right, embodying future economic benefits. Example of liabilities are your trade payable. So you have your a business that supplies you your inventories most of the time, right, or your materials, that you're going to pay them in the future. So that's why namanya trade payables. You also have your loans, you have your advances, and your bonds. And finally, you have the equity. So the equity is the residual interest in the asset of the entity after deducting its all liabilities, right? So residual interest. So it refers to the net asset value. So what is net asset value? You have to identify what is your asset minus all your liabilities. So that would be your entity. Examples of equity are your ordinary shares. All right, and last time I mentioned about retained earnings. And of course, later you'll see revaluation reserve or capital. So coming back to the example here, based on the definition, asset, liability, and equity, let's look at how we are going to put this into the elements of the financial statement, right? So when you invest, all right, when you invest your money, we call that as a capital. Okay, so match with the items, which one is your equity? Equity is the capital that is invested by the owner, 45,000. The bank loan, right? So you have here, bank loan is a liability. The 5,000 you receive from the bank, you have to pay them later. So it's an obligation to pay in the future. So that is a liability. Your asset, all right, because this asset will give you resources that is controlled by business and bring future economic benefits. So that's why you have your assets in the form of your small shop is an asset. Your cash register is an asset. The furniture and shelf that you bought is an asset. Books, that is your one that you're going to sell later, is also an asset. All right, and of course, cash is also your asset. So if you look at here, all right, this is what we call accounting equation. Accounting equation equals to asset equals to liability plus equity. At any point of time, you will always have your asset equals to liability plus equity. right? At any point of time. If you do not have this accounting equation, you will not, means that your account is wrong. Okay, let's look at your asset side. How much asset do you have? You have a small shop of 40,000 plus cash register of 1,000, furniture and shelf of 4,000, books 3,000, and you also have cash of 2,000. So how much you have? 40 plus 1, 41, 45, 48, and 50,000. So how much asset do you have? 50,000. Right, this 50,000 is what we call asset represented by. How do you manage to have an asset of 50,000? Because the asset is financed by the loan of 5,000 from the bank plus 45,000 invested by the owner. So that's why it always has to be equal. All right, the left side and the right side must always be equal. Your total asset must equal to your liability and equity. In other words, it says that in order for you to have that 50,000, you must know where the source comes from, how the assets are financed. In this case, your asset 50,000 is financed by a bank loan of 5,000, which is a liability, and investment of 45,000 by the owner, what we call equity, right? So at any point of time, the equation must always balance. Anyone not clear about this? No, yeah? Okay, next. So looks like the example here. So we have the asset will always equals to liability plus equity. So we're going to look at how are we going to look at the movement or the changes in the business, all right, and how is it reflected in our accounting equation, right? So first, Mr. Anoni invested 45,000 in his business. So remember that now you have to look at the business as its own, right? It's a separate entity. So you have 45,000 put into the business. So 45,000 is in the form of cash. All right, Anoni invested 45,000 cash into the business. So now the company has a cash of 45,000. All right, so whatever invested by the owner is called capital, and that is a form of equity. So you have 45,000 on the right side. So liability and equity we call it as on the right side, asset is on the left side. All right, asset is the left side, liability and equity is on the right side. So left and right must always be the same amount. So now you have on the asset side, we have 45,000. On the right side, you have a capital of 45,000. Right? Liability is 0 now. So 45 equals to 0 plus 45. Okay? So you have that 45,000 on both sides. Next is that we have 45,000 and 45,000. Next, we have got a loan from bank. So when you get a loan from bank means that your cash increased by 5,000, but that loan is also a liability. So you have to record that cash, you receive cash, which is an asset of 5,000. And at the same time, that 5,000 is a liability, right? So now you have how much on the asset side? 45 cash, and then you have another cash 5,000. So you have 45, 5, you have 50,000 on the asset. On the left side, you have liability of 5,000 and a capital of 45,000. In total, is also 50,000. So the left side asset, you have 50,000. On the right side, liability and equity, you also have 50,000. Now you have 50 and 50 on both sides. So you are okay. Then he bought a small shop for 40,000 cash. So when you buy something using cash, of course your cash decreases. All right. So how much cash decrease? In this case, when you purchase the shop, all right, you have to pay out cash. So cash decreases by 50,000. But at the same time, you now have a shop that costs 40,000. So your cash, of course, when you have that bracket, it means that decrease. cash you have to reduce by 40,000 because you have to pay. It's an outflow. So you have to pay cash 40,000, but at the same time you create an asset of 40,000 in the form of shop. See? So we have 45,000 plus 5 minus 40 plus 40. Now you still have 50,000. So in this case, you only have the changes is that you reduce cash but you increase shop. Both are assets, so it's zero rise, right? So there's no changes on the liability side, but you see that on both sides, you still have that 50,000 and 50,000. Okay, how do you know you have 50,000 on the left side? You have 45,000 plus 5, you have 50, and then you minus 40 cash, but you add your shop 40,000. So you will have a total on the asset side 50,000. No change on the liability and equity means that your liability and equity stay 45 plus 5, which is also 50,000. Okay. Then you bought a cash register for 1,000. So again, now cash reduces. So you cash reduce by 1,000. At the same time, cash register increases, right? So you have decreased cash on asset side, but register also increases by 1,000. Yeah. Now you have a new asset called cash register. So again, on the same side, asset, there's no change in value, but there is change in terms of the cash that you have. Yeah, cash now 45 plus 5 minus 40, now minus 1. So you have less cash now. No changes on the liability and the equity side. Right? So can you do the same for furniture and shelf? So now you buy furniture and shelf that cost you 4,000. So when you buy cash, means that cash reduced by 4,000, furniture and shelf is your asset, increased by 4,000. You buy books, 3,000, and then of course you have to pay that by cash. So because of that, you will see that your cash reduced by 4,000, but you have a new asset we call furniture and furniture and shelving. And then you also have reduced cash another 3,000. So you have in inventory now a 3,000. Again, no changes on the liability and the equity side. Okay, so now both sides are still 50,000. Yeah. Okay. Now they come up with the concept of debit and credit. Right? Why is it debit? What is a credit? Right? So on the left side is always what we call the debit side. Asset is a debit. I mean that the nature is a debit, and liability and equity is what we call credit side. Right? So a debit must always equals to the credit side. So whatever you have on the debit side, total must always be the same as total on the credit side. So remember, asset is a debit, liability and equity is a credit side. Okay, asset is debit, liability and equity is a credit. So when you have a double entry, all right, we always look into this equation. All right, remember this equation all the time. Right, so we see had asset is a debit and liability and equity is on credit. All right, so how are we going to record that? So we have asset, liabilities and equity. So first look at the increase, right? Increase in asset is always debit. Increase in liability and equity is always credit. Right? Decrease in asset, all right, whenever, okay, how do you see that increase or decrease? For example, here, when you look at, for example, cash, they have a minus 40,000. So below, when you have the minus 40,000 or bracket 40,000, means that there's a decrease in cash, right? But if it's a positive, means that it's an increase in cash. For example, here we have a cash of 40,000 decrease. So you are going to, so below cash, right, when it's increased, it's debit, right? So for example, cash 45,000 increase, so you're going to debit your cash. But if cash is negative, it means that you are going to credit that cash account. But shop is an asset. Asset positive debit means that shop increased by 40,000, means that you're going to debit your shop account later. All right. So now you have to understand there's a debit and credit, right? So when there's an increase on the asset side, increase is a debit. On the liability and equity side is a credit. So whenever it's increased, the nature is always credit. But the other way around, if it's a decrease in asset, you're going to credit, but decrease in liability and equity, you're going to debit. So it's two sides, all right, one having a debit side, the other one is a credit side. So any increase debit is any increase in asset debit, any increase in liability credit. Any decrease in asset credit, but liability and equity, when it decreases, it becomes debit. So it's the contra of two sides, yeah, because it's two sides. It has to be balanced. So in order to balance it, you have to have that positive and negative, right? So every record of a transaction must have a debit and a credit. Even though it's an asset, all right, debit asset, cash, can you also credit asset? You can, for example, you debit your furniture, for example, is an asset, and then you credit your cash. Yeah, it's also an asset, but it's on the same side. So one increase and the other one is a decrease, right? So if you want to put all these things right into a journal entries, what is a journal entries? That shows the debit and credit of the transaction, right? So for example here, number one, when you have increase in cash, because cash is an asset, so increase in cash of 45,000 means that you're going to debit cash 45,000. Here you have capital equity. Remember, equity is a credit. So when there's an increase in equity, you're going to credit your equity, in this case what we call capital. So you see that debit cash and credit your capital. So that's how you have a debit and credit at all time. All right, so there must always be one debit and the other credit. So that's what I mean, double entry. Double, there are two entry for each transaction. Okay, a minimum two entry for each. Two entry means that must be debit, the other one must be credit. So how you decide whether it's debit or credit? First, you have to identify whether is it an asset, is it a liability or equity. If an asset, is it an increase or decrease? Right? If increase, then debit. If decrease, is a credit. But liability and honest equity, if it's an increase, credit. Decrease is a debit. Similarly, when you purchase when you receive cash from the bank loan, right? So when you receive cash, cash increases, right? So cash increase, you're going to debit. But now bank loan is a liability. Before this, you don't have any bank loan, so it's zero. But now you have a 5,000 liability, so the liability now increases from 0 to 5. So when a liability increase, then you are going to credit the account, right? Similarly, when you buy a bookshop, right? You buy a bookshop for 40,000. When you buy, initially you don't have any shop, but now you have a shop. So that's how you say there's an increase, right? Increase. And bookshop is an asset. So because there is an increase in asset, that's why you debit your bookshop, right? What about your cash? Your cash is an asset, but because you have to pay 40,000, previously you have 50,000, now reduce. By how much? 40,000. So your cash decreases by 40,000. That's why you credit the amount. So you see that in this case, you have bookshop is an asset, cash is also an asset. But in this case, bookshop is a debit entry, cash is a credit entry. Why? Because bookshop increases, cash decreases. Right? Bookshop increase, debit, cash decrease, credit. Even though both are asset. Similarly, when you have your cash register, you debit your cash register and then you credit your cash because cash reduce, right? And cash register, initially you don't have any cash register, but now you do have your cash register. Okay, so you continue to do for your furniture and shelf, right? You debit your furniture. Before this, you don't have any furniture. Now you have a furniture. So you debit your asset, name, furniture, and share, 4,000. But you have to pay cash. So your cash reduced by 4,000. That's why you credit. Right? And then finally, you have inventories. You bought, initially, you don't have any inventory. Now you bought inventories, 3,000. But again, you have to pay cash, 3,000. Okay, so far so good. So here, all right, for the same example here, we are going to put asset here. So you have asset in this case is your small shop. So small shop here is actually a building, right, or a property here. So that's how we categorize the small shop as a building. So we don't have an account what we call small shop. So we just call it as a building, yeah. And cash register is what we call an equipment or machine. Right, so later we are going, because remember that we are not only recording, we are going to classify the transaction according to its type of transaction. Yeah, classification. Furniture and fittings is what we call under features and fittings. Yeah, here furnitures and shelf, we call it as a features and fittings. So all these three is what the big name is called property, plant, and equipment. All right, or we call it as PPE, property, plant, and equipment. So under the big topic, property, you have asset. Under asset, you have PPE, property, plant, and equipment. And under PPE, you're going to say, okay, I have a building of 40,000. I have an equipment of 1,000. I have features and fittings of 4,000. And this PPE is also known as a long-term asset. Long-term means that it can be used by the company for more than 2 years, right? And it's tangible because you can touch that asset, all right? So if you say it's a shop, you can touch the shop, it's tangible. It's a cash register, you can touch the cash register, and even the furniture and fitting, you can touch it. So that's why it's called tangible asset. So later we are going to introduce you what we call intangible asset. It's an asset, but you cannot touch. All right. So that one is later. So under here, and we also call this PPE as a non-current asset. Previously we call it as a fixed asset, but now they use it as an NCA, non-current asset. Right. So we have PPE. Under PPE we have building, equipment, and features and fittings. Your books, remember, what is an inventory? In this case, inventory is what is the goods that you buy for the purpose to resell, right? Inventories are your goods purchased for the purpose of resell and get profit. So if you're talking about bookshop, the books itself is the one that you sell. So when you open a bookshop, intention is that you are going to buy the books at cost and you are going to sell at profit. So if the cost of the book is 10 ringgit, maybe you sell at 12 ringgit. So the difference is 2 ringgit. Yeah, so that's your profit. So inventories is anything, all right, if it's a clothing shop, then clothes is your inventories. All right, if you're talking about is a car dealer, right, motor vehicle, the cars is your inventory. So it depends on the nature of the business. So in this case, it's a bookshop, so books are their inventories. Okay, and these two, all right, your books, your inventory, and your cash is what we call current asset. All right, short-term asset. So because inventories, we will be replenished very, very quickly. All right, again, depending on the types of business that you have. So in this case, we assume that the books will always have 2-3 months, then you're going to have a new books, for example. Yeah, so people will buy the books, and then you are going to replenish the books from your supplier. Right. So when talking about the accounting equation, asset equals to liability plus equity, all right, we can also put that equation on a different way. Asset, if you put the liability on the right side, then you have asset minus liability. Will also give you an equity, Right? So asset minus liability equals to equity, and asset minus liability is what we call net asset. Right? Assets minus liabilities, we call it as a net asset, and net asset should be the same as your equity. In other words, net assets or the equity is the wealth of the business or the owners. All right, at this point, beginning of the year, there's no trade operation. All right, remainder of. That's why it's called net. Yeah, is the remainder. What is balance? Asset minus liabilities is your equity. So in this case example just now, you have asset of 50,000, your liability is 5,000, your equity is 45,000. So if your asset minus liability for 50,000 minus 5,000 is 45,000, that is your net asset. Your net asset is also your equity. That's how you read. And it happens that your net asset is 45,000, your equity is also 45,000. So if you're not given the amount of equity, you should be able to find your equity by having your asset minus your liabilities. Okay. So when the bookshop starts trading, okay, they will conduct trade or business operation to make money. And whenever they make money, we call it as an income. Right? Income can be in the form of revenue and gains. Right? Income can be in the form of revenue and gains. What is a revenue? Revenue is normal operation, selling of your inventories. For example, in this case, a bookshop sells books and others. For example, you can also have a rental income. So that is a revenue, right? But the other type of income is what we call gains, right? So this is realized when you have other activities, right? For example, profit from selling other than inventory. So if you, for example, just now you have a cash register, right? You bought it at 1,000 and then, but you can sell it again for 1,200. So there's a difference there of 200. So that is what we call gain on your disposal of your fixed asset, right? However, in running the business, it will also incur costs, right? Or expenditure, and this is what we call expenses. Expenses under normal operation is the cost of your inventories. So for example, in the case of the bookshop just now, what is the cost of the books? I think it was 3,000 ringgit. Yeah, so that's the cost. But how much is your selling price? That is different. Yeah. And other expenses, for example, you have to pay for the utilities, you have to pay for the electricity, you have to pay your staff. All these are expenses. Salary, for example. What about losses? Losses from the selling of other inventory. So just now we have gain, here we have losses. So for example, if your cash register that you bought 1,000, but after some time you say that, oh, I don't want this cash register, I want to sell it. All right, maybe then you have to sell. Now people is only willing to pay 500 ringgit. All right, so that 500 ringgit, all right, don't make 500. Okay, let's say that you can sell it for 700 ringgit. So the cost is 1,000, but you can only sell at 700 ringgit. So in this case, you have a loss, all right? Loss on disposal of your cash register. So in this case, the loss is also an expense. All right, and then having your income minus your expenses, you will have your net income, or what we call net profit, or what we call remainder of income. In this case, how you get that is income minus your expenses. Okay, so let's say that this is example. Mr. Anoni bought books for 3,000. In January, he sold 20 books. Sales for January total to 1,000. Right, sales 1,000. The cost of the book that was sold was 600. The bookshop expenses, in this case utilities, for January was 70 ringgit. Can you calculate the net income for January? So January, you have income in the form of revenue. What is revenue? Is your sales of the 20 books, and that sales total 1,000 ringgit. So that's your revenue. What about your cost of goods sold? How much is the cost of the book? It said that the cost was 600 ringgit. So you have to call revenue minus your cost of the goods that you sold. And then you're also going to minus your expenses. In this case, your expense is in the form of utilities. How much is it? It's 70 ringgit. So having a revenue of 1,000, cost of goods sold is 600, expense is 70 ringgit, then you have a net income of 330. Yeah, so that 330 is what we call net income, which is actually later you see that this one is the remainder of the equity. Right? Okay. So in order for you to have the income, as I mentioned earlier, you have two types of income, revenue and gains. Yeah, increase economic benefit, is revenue, cost of, okay, this one I've gone through. So example of revenue, sales of goods, revenue from rendering of services. Right, remember that business, you can sell goods or you can render services. So there are two types of business. Fees, interest, dividend, royalties, and rental. Gains are the items that meet the definition of income which may or may not arise in the course of the ordinary activity of an entity. Example of gains, gains from disposal of machine, gain from revaluation of marketable security and non-current asset. Okay, what about expenses? It decreases your economic benefit during the accounting period. Example of expenses, cost of sales, salaries, wages, utilities, and depreciation. What about losses? Losses are items that meet the definition of expense and may or may not arise in the course of ordinary activity of the business. For example, we're talking about losses from flood, losses from disposal of vehicle. All right, so for example, if I have a bookshop, all right, and then I bought a motor vehicle for the bookshop. After a few years, I dispose of my motor vehicle. So the disposal of the motor vehicle does not happen every day, like you sell books, right? Or it's not that you every month you sell your motor vehicle. No, that one is not ordinary business activities. Yeah, that's why it fall under losses. If you have losses, right? Habis. Aduh. Then what? What else? Okay, before that, anything? Are you sleeping?
No, madam.
No, madam.
Huh? Still awake, huh? I almost go to sleep also. While talking, I want to sleep also. Give me another 20 minutes, yeah? Then we go to sleep together. Okay, so it stops there, right? It stops there, stop presenting. What else do we have in chapter 3? I'm not sure. I thought that I will finish until there. Hold on, let me check. Take a break of a few minutes break while I look into the course content. Okay, coming back. Are you still here?
Yes.
Yes. All right. Let's see some tutorial question and see whether we can have some ideas of what we have actually covered just now. Yeah. Okay, let's look. Can you see this question number 1 here? Or I'm not sure whether it's too difficult or okay or not. Let's try balance lah terus, prepare journal entries. Okay, so let's look at this. All right, I just want to identify that you know what these are. Okay, especially for those who do not have the balance. FAR1. Saida.
Assalamualaikum, madam.
Waalaikumsalam. Are you okay so far?
Yes, madam. I'm okay.
All right. Nordiana.
Yes, madam.
Are you following?
Yes, I'm following.
So far so good, huh?
So far, yes, it's so good.
Nazrul? Is Nazrul Ilyas here? Not yet. Shadila?
Yes, madam.
How do you find it? This one is very easy for you, right? Huh? Maizatul and Fatiha?
Yes, madam.
This one is also following, yeah?
Yeah.
Okay, good. All right, let's see. If you have, especially, I'm going to give a special attention to those with no background, right? So if they can follow means that those with the background can do a lot better, yeah? Okay. So now we have list below a number. Right, so you have the cash account, account receivable. So you have number 1, number 2, number 3, number 4, number 5, 6, 7, 8, 9. So cash, account receivable, land, and building. So all these are what? What type? Asset, liability, or honest equity?
Asset.
Asset, madam.
Asset. Very good. Delivery equipment?
Asset.
Asset.
What about notes payable?
Liabilities.
When you see payable, pay, you have to pay, payable is always a liability. The difference is that notes here is more of a contract, accounts payable is of a normal supplier. Yeah. We have capital stock, and this is a US book, no, we call it as a share capital. So this is your equity, and retained earnings is also part of your equity. So later we look into retained earning lah, but at this point of time, you should know that your retained earning is part of your equity. Okay, so what are you required? You are to indicate for each transaction the accounts that should be debited and credited by inserting the proper account number in the space provided. Right? So let's say, for example, where are we? Okay, let's say, okay, you have to identify the transaction. For example, here we have a purchase delivery equipment. You purchase delivery equipment, which is item number 5. You pay part cash and the balance in account, right? So how many accounts will be affected here? You purchase a delivery equipment, so one is delivery equipment, and then you pay part by cash, so you pay cash. And the balance on account, so when you look into account, it means that it's on credit, means that you're going to pay that later. Right? You're talking, in this case, you're going to pay the supplier later on the balance of the delivery equipment. So there are 3 accounts involved here. So you know that delivery equipment is an asset, cash is an asset. What about balance on account? What do you call that?
Liability.
It's a liability. Which account would be? Which account number? Which
7.
account you think that you're going to create?
Account payable.
Yes, you create an accounts payable because you're going to pay that later, right? So now we have asset in the form of equipment and cash, and you also have a liability, which is your accounts payable. So delivery equipment is an asset. You have to see that when you purchase a delivery equipment, is there an increase in the delivery equipment? Increase or decrease?
Increase.
Increase.
How do you see that increase? You see that, okay, you have a shop, now you buy delivery equipment. So delivery equipment will be sent to your shop. So now there's an increase in your delivery equipment. So that's how I see it now, right? So there's an increase. So because it's an asset, then when it's increased, you're going to debit your delivery equipment account. So that's why we put a note number 5. But in terms of paying cash, so because you have to pay cash, cash increase or decrease? So when you have to pay, cash has to go out or from your shop, right? So in this case, you can see that you have to pay cash. Cash increase or decrease?
Decrease.
Decreases. So cash is an asset. Now cash decreases. So should you debit or credit?
Credit.
Credit. Right? You please answer quicker lah. Right? Sebab benda ni essentially is very quick one. Very simple one, yeah? So you answer faster, then we can go this faster. So you're going to credit your cash, and also now you have a liability. Why you credit your liability? In this case, accounts payable number 7. Why you credit your liability, accounts payable?
Because increase.
Because decrease of
Because increase in liability. Previously, you don't have any accounts payable, but because you purchase your delivery equipment, now you have accounts payable. So you credit your accounts payable, note number, account number 7. Okay, let's look at it. Now you pay an account payable. So what happened when you pay your account payable? Saida,
Yes, madam.
what happened when you pay account payable? What are the accounts involved? When you pay accounts payable, you pay with what?
Liability.
No, okay, it's an accounts payable is your liability. You pay your accounts payable, but how you pay your accounts payable? By what?
It's
You pay cash,
cash or
right? You use your cash to pay your
Yeah.
accounts payable. So now your cash increase or decrease?
Decrease.
Decrease because you pay, right?
Yes.
When you receive cash, cash increase. But when you pay
Decrease.
cash, then cash
It's decrease.
decrease. So if cash decrease, debit or credit?
It's a debit.
Okay. Cash is an asset. So in this case, asset decreases. Debit or credit?
It's a credit.
It's a credit because why? Because your cash decreases.
Decreases. Yes.
So you go back just now, we say that asset is always, you remember one thing. You remember asset is one side, is increase. When it's an increase, it's debit. The other side, you have liability and owner's equity. So if there is an increase, you credit. So if you remember increase, debit, the other side is credit. So whenever there's a decrease, you do the contra. Decrease, asset, credit, liability and owner equities, and when it decreases, it's debited. Right? So if you remember that, you must remember that, okay, the concept of asset, liability and owner's equity, whether it's debit or credit, then you know whether when there's an increase, it's debit or credited. Okay? Yes, this is the first time being exposed, all right, but take it slowly, but this one is very important. Yeah? You must
madam,
know
thank you.
the debit and credit. All right, now you collect an account receivable. You collect what? You collect cash from your accounts receivable. When you collect from your account receivable, you collect cash. So in this case, cash increase or decreases?
It's
In Shanila,
Increase.
cash increases.
Increase.
Increase. So bila cash increase, debit or credit?
Debit.
Debit.
Debit. What are the other account involved? Accounts receivable, right? Account number 2. So account number 2 here, we have account receivable increase or decrease?
Decrease.
Right, decreases. Because why? Because initially you have, for example, 100, but now because account receivable has paid you, then the amount to be received is lower in the future. Yeah, receivable. So you have a debt, increase your cash, debit cash, credit your accounts, receivable. So that is account number 1 and account number 2. Account number 1 is debited, account number 2 is credited. And then we have issued capital in exchange for cash. So what it says here is that investor, right, put some more money into the business. Or the company issue share capital. So what they give is that they give share capital to investor. So the company will get cash from the investor. So here we only have cash increases. So debit your cash, but you're going to credit your capital stock. In other words, it's a share capital. Yeah, you credit your share capital, account number 8. Why you credit share capital? Because capital is under equity. Increase in capital, it has to be credited. Right? Okay. This is more challenging where it say that you sold some delivery equipment at cost, receive part of the proceed in cash with the balance due in 60 days. So remember, just now you purchased delivery equipment, but now you sell your delivery equipment, right? So now delivery equipment now will increase or decreases from the shop?
Decrease.
Decreases. So decreased delivery equipment is an asset. So you're going to credit delivery equipment, all right? What you receive part in cash. So it means that cash increases, so you debit your cash. The balance will be received in 60 days. So you have accounts receivable. You're going to receive the balance in 60 days. So account receivable is an asset. So now you debit your accounts receivable. Right? So account receivable is number 2. So we have number 1, and then you have the delivery equipment out. So you credit that account. E, you purchase land and building, paying part cash and signing a note payable for the balance. Purchase land and building means that it's an asset increase, so you debit your land and building account. So where is land and building? So you have 2 accounts here, land number 3 and building number 4. How do you pay? Pay part in cash. So means that you pay credit cash lah, because cash now, because you have to pay. Cash decreases, so you credit your cash. And signing a note payable. Note payable is a liability, right? That's why it's in signing a note. Because a note payable is like a contract that you are going to pay in the future for a certain period of time at a certain amount of interest. So there's a note payable. It's a liability, so you're going to credit your liability. Note payable. So there are 4 accounts involved. Land and building is an asset, increase, you debit those 2 accounts. Cash decreases, so you credit cash. And note payable increase, you're going to credit your note payable. And finally, you borrow money from a bank and sign a note payable due in 6 months. This one means that you receive money from a bank, debit your cash. Now you have a liability from a bank, but in this case, you have a note payable. So you credit your note payable. It's an increase in note payable. So this one, note payable number E and note payable number F are 2 separate note payable. Yeah. So you should be able to identify which note payable you are referring to. So it's 2 different accounts. Yeah. Note payable from the bank and note payable for your land and building. Okay. Alright. Penat ni. Okay, let's go back to your slide here. Any of the slide that you are not clear about? Okay. Any question? I have another example here, right? But the question is not, because this is not from the same textbook. This is from different textbook, right? Okay, let's do this true and false. Do it quickly, can you? The credit side of an account is the right side. The credit side is on the right side while the debit side is on the left side. True or false?
True.
True.
Are you sharing the screen?
Am I sharing? No, sorry. Hold on.
Wow.
This. Okay, again. Do it quickly so that we can do a lot of questions, right? Within a few, we have 5 minutes to go. Okay, the credit side of an account is the right side. While the debit side is the left side.
True.
This one you are referring to a T account.
True.
Right? So it's not fair lah, because this one is a T account. So later we introduce the T accounts, not today. In the simplest form, an account has only 3 elements, a title, this one T. All liability accounts normally have a credit balance. True or false?
True.
True.
True. Why? Because remember I said that the nature asset is a debit, liability and owner's equity is a credit. So asset normally have a debit balance, liability and owner's equity will have a credit balance. So this is true. Decreased owner's equity are recorded using debits. True or false? Decrease to owner's equity accounts are recorded using debits.
True.
True. Right?
True.
Equity, decrease, debit. Liability accounts should only be debited and never credited. True or false?
False.
False.
Hence, if it decreases, it will be debited. Increase in owner's equity are recorded by credits. Increase in asset and in liabilities are recorded by debits. True or false?
False.
What is the correct one?
Increased liabilities are recorded by credits.
Increase in owner's equity and liabilities are recorded by credits. Increase in asset are recorded by debits. An increase in a liability is recorded by a credit and increase in owner's equity by a debit.
False.
False. Right? Both should be credit. The left-hand side of an account is used for recording debits and the right-hand side for recording credits.
True.
It should be true.
True.
If the number of debit entries in an account is greater than the number of credit, okay, this one is the balance, never mind. Okay. When making a general journal entry, there can only be one debit and one credit.
False.
False. Right? You can have 2 debits and 1 credit. Right? For example, when you purchase your you purchase your equipment on cash and balance on credit. So you have 3. So you can have more than that. Yeah. Okay, when a company uses the double entry method, the total dollar amount of debits recorded must equal the total number of credits recorded, but the number of debit and credit entries may differ. True or false?
True.
True. Yeah, it means that you can have 2 or 3 debit side and 1 on the credit side, but the total debit and total credit must be the same. Okay, this is too much lah. Okay lah, I stop here. Okay. As I mentioned earlier, that you can have a lot of access to financial accounting and reporting 1, right? If you type financial accounting 1, then you can have some of the resources. All right. I have also, I'm not sure where else can you find, because anyone buy the textbook? Tak ada. Right? Because I have not requested, I'm not sure whether you have to buy the textbook or not, because to me, all right, the required textbook is lengthy, right? It's too wordy, so I prefer the other textbook. But again, it's up to you, because the required textbook is a Malaysian textbook, so it has a lot of Malaysian scenario. The context is in Malaysia, so that's why it's put as a required textbook by the MIA. Yeah. All right, so I think that's all for today. All right, please fill up your attendance form, and if you have any question or things that you are not clear from the class today, please put it in your feedback so that I can look into it and I try to answer in the next class. Right? And if you have question, you can always ask me in the WhatsApp group, right? So I prefer you to ask in the group rather than individual WhatsApp me. Yeah, why? Because sometimes your question others may benefit as well, and some of your question also applicable. The answer is also applicable to all other students. So if you help me to ask the question in the group, all right, that will make it easier for me and for other students as well. All right. Oh, I have to stop recording. So I think that's all for today. Thank you for attention. Please review. All right. Please look for some exercises.